Hi, this is Steve Rising with the Trading Institute. I'd like to take a couple minutes today and talk a little bit about why we use a scalping technique to trade the Forex market. What we're looking at here today is the US dollar versus the Japanese yen, one of the four major currency pairs. And if we look at the extent of the move from start of day here, roughly at midnight right here, to where we are currently here, moving into the afternoon, we can see that the entire move for the day here has been approximately 60 pips, keeping in mind that 10 pips of that move right here with quick reversal was based on a news announcement. So oftentimes what happens is that individuals think that when they trade the Forex, what they want to do is try to find the big move. But you know the old power of leverage, what's easier, to make $100 on one share of stock or to make $1 on 100 shares of stock? Well, obviously the latter is easier, and so we use a similar technique when trading the Forex. We look for a fixed profit objective and we look to bundle lots. In other words, we can see over the bulk of the day the average size moves here were 20 pips, and so for us what we look to do is we look to scalp about 10 pips or net 10 pips out of what's an average size 20 pip move, and then to make more money we simply add more lots. The reality is more people are successful trading a scalping technique in the Forex market than they are trying to find a big move or trying to hold on to a position for an extended period of time. And the reason for this is because the directional bias of this market is constantly shifting. We can be bullish for 3 hours and then bearish for the next 3 hours. And so the key to being successful in trading the Forex for the 90% is to adopt some form of scalping technique. Now, by pure definition, a scalper is someone who's going in looking for very small fractional moves throughout the day and trading very frequently. That's not what we do. In fact, most major Forex brokers will not allow that style of trading. What we do is we use the spirit of the term scalping, where we go for a preconceived profit target prior to each trade. And there's a couple of reasons for this. One I already mentioned was because we know that the bias is constantly shifting, and we know that based on the average size move, it's far easier to go in and, for instance, take a section of the move. In other words, market stalled here at this point, go in and grab a piece of the move and then expect market to stall again or reverse, we're back on the sidelines, and then look for our next move in that fashion. So we know that's a far easier way for people to trade because of this constant shift in the directional bias. And the other is it's psychologically it's much easier for most people because you're not holding positions for extended periods of time. You sleep better, you're less anxious, there's less nerves, and once again it's statistically shown individuals who have a pre-planned profit target in this market do far better than those individuals who try to ride or look for the big move. Interestingly enough, it's been shown across all markets that the individual that has a predetermined profit objective prior to a trade will make 10 times more money over a 5-year period than the individual who tries to ride it out and see if they can take the extent of the move. Because one of my favorite sayings in trading is we never know where the top or the bottom of the move is until after the move is over. We can forecast, but then what we want to do is we want to just simply scalp a section of that forecasted move. So to learn more about our scalping technique that we teach here at the Forex Trading Institute, please attend one of our free online seminars, which you can register directly from our website at theforextradinginstitute.com. This is Steve Rising, and have a fantastic day.